My name is Paul Blig. I'm a tax partner with EisnerAmper in the San Francisco office where we're live streaming today. I'm at my home office in the Bay Area. We're happy to host Ivy Family Offices Network's 2022 Trends Forum. And EisnerAmper is a top 20 national accounting firm and business advisory firm headquartered in New York with offices around the country and globally. We have a significant family office practice with nearly 400 family offices involved in private equity deals, real estate, and more. Our family office solutions provide a wide array of advisory, accounting, and tax services, including outsourced accounting services that Natalie touched upon and technology solutions. Dan Krauss is a tax director also in the San Francisco office in EisnerAmper's family office practice, and he's here today. During my conversation with Dan, we'll get to hear about trends and considerations for family offices from a tax perspective. So before we jump into our topics, Dan, could you please introduce yourself and tell us a little about your practice?
Thanks, Paul. Good afternoon, everybody. As Paul mentioned, I'm a tax director out of the San Francisco office. I am a New York transplant, actually moved to the Bay Area with my wife right before the pandemic in December 2019. So it's been a very interesting time so far getting to know the West Coast. I have about 15 plus years in the public accounting industry, and my primary area of expertise is with family offices and closely held businesses, as well as just working directly with high net worth individuals.
Good. So Dan, what are some trends that you're seeing with your family office clients?
I would say for the most part at this point, the top three pain points for the folks that I work with would be concerns about looming tax reform from the Biden administration, which has kind of been at a stalemate for over a year now. There's been an increased focus on succession planning with the next generation due to fears about the lifetime exemption being significantly reduced to pre-TCJA rates. So we're talking, 12 million could get reduced to 5 million. And then, lastly, I think, as a result of this pandemic, there's been a big shift in how family offices invest their money. And there's certainly been a big reallocation of assets under management to private equity investments.
Based on those trends that you've described, what are some tax strategies that you've been using with your family office clients in response to the possibility of tax reform concerns?
So, there's a couple of we'll call loopholes that, folks are concerned that will close soon. One of them would be, favorable long-term capital gains rates when it comes to federal income tax. Currently that rate is at 20%. And there's fears that rate could grow to 40%. So there's definitely folks that don't mind divesting of highly appreciated stock positions to lock in that favorable tax treatment today. I try to work with their financial advisors to figure out what makes the most sense as far as maybe stacking between 2021 and 2022 once we found out that the legislation wasn't going to get pushed through the Senate to get rid of those rates. And obviously, towards the tail end of the year, the financial advisors are always looking at, tax harvesting losses to try to lessen the blow of a large tax bill from accelerating these gains. Another area of focus for me, throughout the pandemic has been, as far as with closely held businesses, there have been, a couple of clients of mine that have structured transactions where they're not getting all of the cash up front from their deals. This could be a transaction that could take place over the course of a couple of years. So, from a tax perspective, you could treat those types of deals under what we would call the installment method of accounting, which is that you're going to pick up taxable income on a pro rata basis on the sales price versus the amount of cash that you're receiving each year. So, to a certain degree, if there's a very extreme likelihood that there's no doubt as to the collectability of the future installments, depending on a client's appetite for risk, sometimes, the advice has been, forget about recognizing these gains under the installment sale method. Let's just recognize everything in year one to lock in those favorable tax rates.
Good. Are there any income deferral techniques that you've implemented with your family office clients?
Sure. I would say the flavor of the past couple of years for a lot of folks that invest their money in real estate would be with qualified opportunity zone funds. Up until 2021, there was certainly a very large incentive to roll into these types of investments for a couple of reasons. The first being that if you invested your money into one of these funds by the end of 2021, you could be put in a position where if you held your investment for 5 years, you could get a 10% reduction in whatever gains you were deferring into the fund that you invested in. While that isn't on the table anymore, the important things to note about these types of investments are that, number one, it's still something that is taxable in California. California, opted out of this regime. And, number two, as far as how to think about investing in these funds, number one, if you want to make a direct investment into one of these funds based off of just stock sales, you need to time the investment based off of within 180 days from the date of sale. Another approach could be if you're invested in a flow-through entity, which could be a partnership or an S corporation, if you're aware of a very large liquidity event that's going to be happening within one of those investments, you can time your investment into an opportunity zone fund based off of the filing date of the entity's tax return. So, for example, if you have an entity whose year end is on December 31st, the due date of their tax return would be March 15th of the following year. You could then have 180 days from March 15th to make investment into the fund in order to get preferential tax deferrals. In this case, we're talking about 2021.
So it's better, you get a longer runway if your gain occurs through a partnership versus selling stuff.
Yes, that is correct.
Okay. And so when does the federal tax bill come due for the gains invested in a opportunity zone?
So at this point, it doesn't matter in which year you opted to make the investment. Everybody's tax bill is going to come due for the year ending December 31st, 2026. And okay. Just to add on to, that people might have a question, well, you mentioned this benefit about the 10% reduction in whatever gain you're deferring, that went away at the end of 2021. So why would I be incentivized to do this in 2022 and beyond? And the answer to that would be that if you invest into one of these funds and you hold the investment for 10 years, any appreciation on your principal can come out of the fund tax-free. So it operates very similarly to a Roth IRA.
Wow. Since the 2018 Tax Act, a large number of the attendees today that live in high-income states have a limited state tax deduction of just $10,000 on their federal income tax return, and combined with state income and property taxes. What planning have you done with your clients to make up for or get around this lost tax benefit?
Great question. As of today, nearly half the states in our country that actually have a state income tax have passed something called a pass-through entity tax. And under this regime, individuals can recoup their federal tax benefit by being put in a position where if they're invested in either an S corporation or a partnership, it could elect on their behalf to pay an entity level tax on whatever taxable income is going to be allocated to the owner. And so what ends up happening is that, hypothetically speaking, if you have, let's say, taxable income that's going to be allocated to you of $1 million, and you make this election in the partnership or the S corporation, they pay the tax on your behalf. Whatever tax gets paid, that will be a deduction that will offset your federal taxable income. Okay. And therefore, you're getting around that $10,000 SALT limit that you would ordinarily have if you didn't make the election and you just took your state and local taxes as an itemized deduction. From the state level, if you decide to make this election, it's really dependent upon the state in which you're making the election that offers this regime. Some states will allow you to take a credit for the taxes that are paid by that entity against your tax bill. Alternatively speaking, there are some states that will allow you to just exclude the income allocable to the partnership or S corporation that made the election on your behalf.
And so the entity pays the tax that's going to be credited to that shareholder, and that reduces the entity's federal taxable income. So you get completely around the state tax limit.
Yep, that's correct.
Does California offer this?
They do. California was a little bit late to the party. The first round of legislation that they passed was enacted in July of 2021. And, there were a lot of issues with that legislation. The two biggest issues, number one, was that it limited the amount of people that could actually participate in the regime. And number two, the legislation put a floor on how much could reduce your state tax liability on an annual basis. And the problem with that floor is that based off of how the bill was written, first off, the credit is non-refundable. And secondly, if you're not allowed to use the credit in year one, you can carry that credit forward for up to 5 years. But if you can't use it in 5 years, you lose it. So a lot of people were weighing the tax benefit at the federal level versus the potential loss benefit that you would get for California if you couldn't use the credit. So after a lot of complaining from tax practitioners and just regular people that were obviously very upset about the bill, California came around. They revised the legislation in February of 2022, and they made the legislation retroactive to tax years starting in January 1st of 2021 to get rid of this floor and to just make the tax legislation more inclusive to anybody that wanted to participate that was an owner of a partnership or an S corporation. The basics behind the bill as they currently stand as of today: number one, the tax rate in effect is 9.3%. So if you have taxable income of $1 million, you're going to pay a tax of $93,000. If you have a effective tax rate on your federal taxable income of 37%, that gives you a federal tax benefit of $35,000. So it's a very powerful tool if you happen to be in a position where you're an owner in a pass-through entity and the entity is doing well for itself.
And have you been making the election? Do you have clients that are doing this?
So I have some family office clients. They have family partnerships, and we've taken the position that, based off of the fact that the family members are very much actively involved in the investment decisions of the partnership, that they're eligible to make this election on any income that flows through to the partnership from the underlying investments that they have, which could comprise private equity, hedge funds, or just even managed portfolios.
What other considerations should be made before making the pass-through entity tax election?
So I would say from a business owner perspective, if you're running a multi-state business, you need to consider if, for instance, a lot of your income is allocated out of your home state, you need to make sure that if you make the election in, we'll call it the foreign state, that your home state will allow you to take a credit against your tax liability for this PTE election that you're making out of state. Another area that has been a problem, an example would be New York. New York is an all or nothing proposition, meaning all of the owners have to give consent for the business to make the election. So if you have, some partners that are non-residents of New York and they don't want to make the election, that becomes a problem for the residents of New York that want to make the election. So, that's really a conversation that needs to be had with all the partners to just understand, whether or not you can all make the election or if some people can opt out. And I would say, finally, due to all the states that have passed this law, all the states have different rules when it comes to a credit versus excluding income versus whether everybody has to opt in or if some people need to opt out. So before you make the election, you really need to talk to your tax advisor and make sure that you understand the rules of the particular state that you're looking to enter this regime in.
Well, for multi-state businesses, it just makes it exponentially more complicated to decipher whether you should make the election and what's involved.
Well, that's why you have to pay a tax advisor the big bucks.
You mentioned that you've seen an increased focus on family succession planning. What role have you played in that process as a tax advisor?
So, most of the clients that, I've worked with have done quite a bit of wealth transfers when it comes to trust and estate planning. But this really happened over 10 years ago when the lifetime exemption amount per taxpayer was $5 million. Starting in 2018, the exemption amount got raised to 11 million. And as of 2022, the magic number is about 12.1 million. So with the possibility that that exemption might drop back down to $5 million as a result of what the Biden administration is trying to do, a lot of my clients with taxable estates are at least revisiting the idea of additional wealth transfers before it's too late and that exemption drops back down to $5 million.
And what wealth transfer techniques have you seen in the marketplace lately?
So I had mentioned before when we were talking about the pass-through entity tax that a lot of my family office clients have a family limited partnership structure. In a lot of these family partnerships, the underlying investments are mainly publicly traded securities and alternative investments in both private equity and hedge. Based off of market conditions, and I'm sure a lot of people on this call can relate, and they probably don't even want to look at what the value of their portfolio is right now. They're rushing to, gift a larger percentage of their limited partnership interest to their heirs because you can get, much larger valuation discounts just based off of where the market is today. So this is, while, it's painful to look at your portfolio right now, there's a big opportunity on the trust and estate planning side. If you want to gift away a larger limited partnership interest when values are down.
I see. What wealth transfer strategy is available for taxpayers that have maxed out on their lifetime exemption amount and they don't want to pay gift taxes?
So there is a a structure that we've been advising our clients on that provide a income tax benefit as well as an estate planning benefit. The structure that I'm talking about is called the Charitable Lead Annuity Trust, also known as a CLAT. In a CLAT structure, you have an individual known as a grantor set up what would be called a grantor trust. Within the trust, you would have to name a charitable beneficiary, which could be a public charity. For people that want a little bit more flexibility about the charitable beneficiary, you could designate your donor advised fund as your charitable beneficiary. The trust life would generally be between 10 to 15 years. And what would happen in this structure is that your grantor would contribute, they could contribute cash, they can contribute assets that we know will appreciate over time. Once you contribute these assets into the trust, you will immediately get a tax deduction in the form of a charitable deduction based off the value of the asset that you're placing in the trust. And based off of the 10 or 15-year life of the trust that you've set up, you're making annual annuity payments to your charitable beneficiary, which is generally based off of the value of the assets that you've placed, plus an annual interest rate that is set by the IRS. Right now, that annual interest rate is around, I think, 3%. So it's very minimal based off of the market returns that you can get, because over that 10 to 15-year trust term, since you're not giving away your assets that you contributed in one fell swoop, your assets are allowed to appreciate over that 10 or 15-year period. So by the time everything has elapsed, and you've given away that needs to go to your charitable beneficiary, whatever residue you have left over, i.e. the appreciation from the assets, that could then get transferred to your heirs gift tax free, assuming certain conditions are met.
That's great. Great. What challenges have you seen family offices face by allocating a larger percentage of their capital into private equity investments?
So, generally speaking, private equity investments are, they're made with, the long-term approach in mind, due to the substantial growth that's at stake with these types of investments. They're closed-ended, which means that you're going to have restrictions on when you can transfer the stock. And those restrictions are going to last for, a certain period of time, which you're going to have to adhere to. As a result, family offices that are devoting a larger percentages of their assets to this type of investment need to consider the cash flow crunch that could come about if you don't have the appropriate financial forecasting in place.
And what advice do you give family office clients about the cash crunch, the liquidity concerns?
So number one, I've aligned myself with very smart financial advisors that specialize in helping our clients figure out ways to liquidate any sort of heavily concentrated positions in these types of private investments. So really, my role in this is to shut up, let the financial advisors do the work. And when they come up with a really smart strategy, I then chime in and tell my clients what the tax bill is going to look like. Outside of that, the other thing that, I always recommend is that you really need the right financial reporting technology in place so that, your family office, they could really figure out for budgeting purposes and to really understand investment performance and to properly evaluate investment decisions. Without this technology in place, those things could be lacking.
And can you talk about some of the tax opportunities, advantages of private equity investments?
I would say the biggest play at this point, and this is a loophole that the IRS has tried to close, and the Biden administration is actively focused on it, is something called qualified small business stock under Section 1202. Basically, what you're looking at is you have to have a USC corporation. you meaning the family office, needs to acquire the stock upon original issuance from the corporation, or it could be through inheritance. There's other thresholds that the corporation has to meet, but we're not going to get into that today. Basically, the big takeaway is that if you invest in something that meets these standards, and all of a sudden you have a substantial amount of appreciation, when you sell your investment, you can exclude up to $10 million of your gain, or up to 10 times the cost of the investment, whichever is greater when you sell it. This is strictly a federal tax benefit for any California residents that are listening to this. California, unfortunately, does not adhere to this tax regime, but very, very powerful tool as far as a federal tax benefit is concerned.
Fantastic. So it looks like we're going to stop here. Thanks, Dan. And thank you to all of our guests for joining this session. If you have any questions, please don't hesitate to reach out. We'll add our contact information. And Marty, I'll turn it back over to you.
Well, thank you so much. It's a great presentation. I think that, you know, in a multi-state environment for so many family offices, you need a multi-state accounting firm who can help you with all that. So it's extremely relevant. So I wanted to thank EisnerAmper for hosting us. We've been working with them for years in New York. And so it's great to establish the relationship here in California. And just some quick reminders that we're going to be in New York on June 28th to 29th. Then September 7th and 8th, and then we'll be back in California in September 28th to 29th. We've got a big event in Dallas in October, and then we'll also be in Miami for Art Basel come November. So